bank failures. Let me be very, very clear. Silicon Valley Bank collapsed because of management failures and possible regulatory weaknesses, not because there was one black man on the board. We saw the same racist playbook during the 2008 financial crisis when some Republicans blamed the Community Reinvestment Act and loans made to people of color. Rest assured, Democrats will not stand for this blatant racism. With that, Mr. Chair, I yield back the balance of my time.
We'll now recognize the Vice Chair of the full committee, Mr. Hill, for 1 minute.
Thank you, Mr. Chairman. Today we're confronted with the results after 10 years of too loose monetary policy and recent wildly excessive spending. Some bank management teams have forgotten their prudential obligations to their depositors and their shareholders. And clearly, many customers forgot their own prudence and their own financial responsibility. But as our committee comes together, the chair, the ranking member, and members are concerned about the supervisory failures by the regulators who are supposed to keep a watchful eye. Some lawmakers have been quick to use this crisis to put politics to push their preferred policy outcomes. But that's premature. We need to first understand what happened, when, and why, both leading up to the bank failures as well as the decisions made by your agencies represented in our panel today in response. Only then can we decide the proper path forward. That's why Republicans are conducting a comprehensive review, starting with oversight letters to the Federal Reserve, the San Francisco Fed, the FDIC, the FSOC, the California and New York state regulators. We expect your full cooperation in this matter, and make no mistake, today's hearing is just a first step in that process. I thank the chair for the hearing, and I yield back.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters, for convening at this crucial time, and thank to our esteemed witnesses for being here today. I remain proud of what we did almost 13 years ago with the Dodd-Frank Act. Although COVID presented novel and considerable challenges to our banking system, the system held. And these recent events represent the first real stress event since the 2008 crisis, when banks dealt with run risk and serious liquidity concerns. What we've learned is that we now have to reinforce our banking system against bank runs that can occur at the speed of the internet. This will require stronger emergency liquidity provision to banks under attack, and it has to be available 24 hours a day, 7 days a week. This will then require liquidity providers to have a clear and simple means of knowing that they are loaning to an entity which will ultimately remain solvent. I also believe that we have a lot to learn by the two side-by-side bank failures, Silicon Valley Bank with total assets less than 1% of GDP, and Credit Suisse with total assets greater than 100% of Swiss GDP. And the difference, I believe, is contingent capital. Had we followed Congress's direction to include contingent capital into the stacks of U.S. large banks, we would have been able to resolve the SVB without hitting the Deposit Insurance Fund. And I'll be bringing that up in my questions and yield back.
Today we'll hear testimony from the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Grunberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and the Honorable Nellie Lang, of Undersecretary for Domestic Finance of the U.S. Department of Treasury. We thank each of you for your time, and we're going to be recognized for 5 minutes for our oral presentation of your written testimony. We'll begin with you, Mr. Barr.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory oversight of Silicon Valley Bank. Our banking system is sound and resilient, with strong capital and liquidity. The Federal Reserve, working with the Treasury Department and FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as necessary.
If the gentleman will dispense for a second. Mr. Foster, you'll turn off your mic. Thank you. We'll let you continue. Thank you.
Shall I proceed?
Oh, all right. Go ahead. If everybody will check your mics and make sure you're off. Did you just do that to Mr. Torres? All right. See, we can even have a sense of humor in the midst of serious stuff. We'll let you continue. Thank you, Vice Chair Barr.
Thank you, Mr. Chair. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as needed to keep the system safe and sound. At the same time, the events of the last few weeks raise questions about what more can be done and should be done so that isolated banking problems do not undermine confidence in healthy banks and threaten the stability of the banking system as a whole. At the forefront of my mind is the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, and the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our own supervisory engagement with the bank, and the regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve framework focuses on size thresholds, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risk that led to its failure. We are also assessing whether SVB would have had higher levels of capital and liquidity under higher standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III Endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion, like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resiliency of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technologies and emerging risks. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission. Thank you, and I look forward to your questions.
We'll now recognize Chairman Grunberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you very much for the opportunity to appear before you today to address the federal regulators' response to the recent bank failures. On March 10th, just over 2 weeks ago, Silicon Valley Bank, or SVB as it's known, with $209 billion in assets at year-end 2022, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. The failure of SVB, following the March 8th announcement by Silvergate Bank that it would voluntarily liquidate, signaled the possibility of a contagion effect on other banks. On Sunday, March 12th, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, was closed by the New York State Department of Financial Services, which also appointed the FDIC as receiver. With other institutions experiencing stress, serious concerns arose about a broader economic spillover from these failures. After careful analysis and deliberation, The boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors in winding down SVB and Signature Bank. It's worth noting that these two institutions were allowed to fail. Shareholders lost their investment, unsecured creditors took losses, the boards and the most senior executives were removed. The FDIC has authority to investigate and hold accountable the directors and officers of the banks for the losses they caused to the banks and for any misconduct in the management of the banks, and the FDIC has already commenced those investigations. Further, any losses to the FDIC's deposit insurance fund as a result of uninsured deposit insurance coverage will be repaid by a special assessment on banks as required by law. The FDIC has now completed the sale of both bridge banks to acquiring institutions. My written testimony today describes the events leading up to the failures of SVB and Signature Bank and the facts and circumstances that prompted the decision to utilize the authority in the Federal Deposit Insurance Act to protect all depositors in those banks following those failures. It further describes the management and disposition of the bridge institutions that were established. It also discusses the FDIC's assessment of the current state of the U.S. financial system, which remains sound despite these events. And in addition, it shares some preliminary lessons learned as we look back on the immediate aftermath of this episode. In that regard, the FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration related to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's Chief Risk Officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. Further, the FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rate risk, and also the consideration of a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from these failures have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future. Mr. Chairman, that concludes my statement. I'd be glad to respond to questions.
Thank you. Undersecretary Lang.
Ranking Member Waters, members of the committee, thank you for inviting me to testify today and for the opportunity to speak several times in recent weeks to share updates from Treasury regarding current events. The American economy relies on a healthy—
If you'd pull your mic closer or direct it towards you, thank you.
The American economy relies on a healthy and diverse banking system, one that includes large, small, and mid-sized banks, and provides for the financial needs of families, businesses, and local communities. Nearly 3 weeks ago, problems emerged at 2 banks with the potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government took decisive actions to strengthen public confidence in the U.S. banking system and to protect the American economy. On March 9th, depositors of Silicon Valley Bank withdrew $42 billion in deposits in a period of just a few hours. After concluding that significant deposit withdrawals would continue the next day, the California state regulator closed SVB and appointed the FDIC as receiver. 2 days later, the New York financial regulator closed Signature Bank, which also had experienced a depositor run, and appointed the FDIC as receiver. Treasury worked to assess the effects of these failures on the broader banking system, consulting regularly with the Federal Reserve and FDIC. On Sunday evening, recognizing the urgency of reducing uncertainty for Monday morning, Treasury, the Federal Reserve, and the FDIC announced a number of actions to stem uninsured depositor runs and to prevent significant disruptions to households and businesses. First, the boards of the FDIC and the Federal Reserve recommended unanimously, and Secretary Yellen approved after consulting with the President, 2 actions that would enable the FDIC to complete its resolution of the 2 banks in a manner that fully protects all of their depositors. These actions ensured that businesses could continue to make payroll and that families could access their funds. Depositors were protected by the Deposit Insurance Fund. Equity holders and bond holders of the banks were not covered. Second, the Federal Reserve created the Bank Term Funding Program, a new facility to provide term funding to all insured depository institutions eligible for primary credit at the discount window, based on their holdings of Treasury and agency debt securities. This program, along with the pre-existing discount window, has helped banks to meet depositor demands and bolstered liquidity in the banking system. This 2-pronged, targeted approach was necessary to reassure depositors at all banks and to protect the U.S. banking system and economy. These actions have helped to stabilize deposits throughout the country and provided depositors with confidence that their funds were safe. In addition to these actions, on March 16th, 11 banks deposited $30 billion into First Republic Bank. The actions of these large and mid-sized banks represent a vote of confidence in the banking system and demonstrate the importance of banks of all sizes working to keep our economy strong. Moreover, on March 20th, the deposits in certain assets of Signature Bridge Bank were acquired from the FDIC, and on March 26th, the deposits in certain assets of Silicon Valley Bridge Bank were acquired from the FDIC. We continue to closely monitor developments across the banking and financial system and coordinate with federal and state regulators. As Secretary Yellen has said, we have used important tools to act quickly to prevent contagion, and they are tools we would use again to ensure that American deposits are safe. Looking forward, while we do not yet have all the details about the failures of the 2 banks, we do know that the recent developments are very different from those of the global financial crisis. Back then, many financial institutions came under stress because they held low credit quality assets. This was not at all the catalyst for the recent events. Our financial system is significantly stronger than it was 15 years ago. This is in large part due to the post-crisis reforms for stronger capital and liquidity. As you know, the Federal Reserve announced a review of the failure of SVB and the FDIC a review of Signature Bank. I fully support these reviews and look forward to learning more in order to inform any regulatory and supervisory responses. We must ensure that our bank regulatory policies and supervision are appropriate for the risks, old and new, that banks face today. Thank you to the committee for its leadership on these important issues and for inviting me here to testify today. I look forward to your questions.
I recognize myself for 5 minutes for questions. Undersecretary Lang, when did you become aware of the severe financial distress of Silicon Valley Bank?
Chairman
Date and time
Henry,
would be helpful.
We became aware.
When did you become aware? I'm going
I
to
became
you.
aware of issues at Silicon Valley Bank on Wednesday or Thursday.
Wednesday or Thursday. I would like to have a written response to when you became aware. You can search your email, that'd be helpful. Vice Chair Barr, when did you become aware?
Thank you, Mr. Chair.
When did you become aware of SBB's
Sorry.
financial distress?
I was going to answer that Thursday morning I received an email from staff indicating that Wednesday evening the bank had difficulty.
Thursday morning. When did you become aware, Vice Chairman?
I believe it was Thursday evening. Staff came into a meeting I was at.
Thursday evening for Silicon Valley Bank. Okay. Along those lines, and you had a staff presentation in February that included Silicon Valley Bank and the distress because of rising interest rates on their portfolio. What did you do between that February staff presentation to you and the week of March 6th about Silicon Valley Bank?
Staff presented on the interest rate risk.
Yes, that's what I said. That was the February presentation. What did you do as Vice Chair of Supervision between that time and the bank, the week of the bank failure?
Staff indicated that they were completing their review of the bank and of this broader horizontal review at that time, and I was waiting for the results of that review.
Were you aware of Silicon Valley Bank raising capital the week of March 6th?
I believe I became aware of that in this email that I described to you.
On Thursday morning, that they had successfully raised the capital, but they're facing financial distress.
I was not aware Thursday morning that there were deposit outflows. I was trying to finish the answer to that question. I was aware of the difficulty Wednesday night in raising capital, but the bank was reporting to supervisors Thursday morning that deposits were stable.
When did you become aware of the deposit flows? On Thursday.
Thursday afternoon, late afternoon, I became aware of deposit flows, and Thursday evening that there was essentially a bank run.
So Thursday afternoon, which could be mid-morning in California? Is that what you're suggesting?
I believe it was around noon in California, and for me around 3 o'clock.
Okay. And did you make provision for the discount window or pledgeable assets at that time you heard of their distress?
My understanding from the staff is they were in discussions with the bank itself beginning Thursday afternoon to try and move pledgeable collateral over to the discount window. That work continued Thursday afternoon, Thursday evening, and actually overnight.
Did you make provision to keep the discount window open so they could provision collateral to avoid a bank collapse?
The discount window opening decision is sort of like a standard thing. It normally closes.
A standard thing, except in a moment of crisis. It can be kept open. I think the Vice Chair for Supervision should be able to make that phone call. Did you provision for that? Or did you think you needed a provision for that?
Mr. Chairman, at the time, my understanding was that the difficulty wasn't sending funds. The difficulty was actually getting the collateral, evaluating the collateral, and getting it pledged to the discount window. And staff were working with Silicon Valley Bank basically all afternoon and evening and through the morning the next day to pledge as much collateral as humanly possible to the discount.
So on Friday morning, Vice Chair, Chair Grunberg, you were appointed receiver. When did you become aware that FDIC was going to have to take this measure or was going to receive this bank?
I think when we were informed Thursday evening.
I mean were you informed Thursday?
I was informed Thursday evening by staff.
Which meant you had Friday morning conference calls to make a decision. Was that part of it?
I think we were, I think we knew Thursday evening that the bank was going to fail and that we needed to make provision to take over the institution.
Did you pick up the phone and call the Vice Chair of Supervision at the Fed and say, how can we provision to keep this institution open for a Friday?
I can't recall that. My recollection is, Mr. Chairman, that the institution was experiencing a liquidity failure and that it was going to fail. And
it was going to fail on Friday open or Friday evening? Were you provisioning for this for the weekend decision?
No, I think the expectation and their experience was that the institution was going to be closed in the morning.
At what point did you open an auction for Silicon Valley Bank? On Friday?
I believe it was Sunday afternoon.
Sunday afternoon you opened for auction. So that weekend, what happened we only heard the announcement of Congress receiving this information at 11:20 on Friday morning. There was an idiosyncratic bank. And Sunday afternoon was the next pronouncement from any of you three on the panel, and it was a systemic risk designation. That's what shook the market for the last 2 weeks. That's the reason why we've had these extraordinary interventions in the financial system. And I want to know the key details of that weekend. I hope we can drill into those questions.
Sure.
With that, I'll recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chair Gruenberg, we know that SVB banked nearly half of all U.S. venture-backed startups, potentially tens of thousands of companies, which clearly posed a concentration risk to the bank. While most of the bank's depositors were small and mid-sized businesses, they also had large customers too, with the top 10 accounts holding more than $13 billion in combined deposits. Chair Gruenberg and Vice Chair Barr, I'm concerned that depositors' decision to run or stay were not necessarily made on their own, but by the strong encouragement of their venture capital backers who sit on the boards and hold equity in their companies. Were a handful of large venture capital depositors able to influence the withdrawal of $42 billion all at once through their control over their portfolio companies?
Congresswoman, I think that is something we'll need to look at in terms of the post-failure review of these institutions. I couldn't tell you today, with certainty what occurred there. I know both the Fed in regard to SVB and we in regard to Signature are going to do a careful review of the events that occurred.
Thank you very much, and I agree with you. I think we really need to know the role that venture capitals played in this bank. Going further, Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, which is considered deficient, but was considered sufficiently capitalized, given the bank's unique customer base, extremely large share of uninsured deposits, and underwater asset portfolio. Liquidity management was also a key issue. The liquidity rating for a bank should account for interest rate risk and the bank's asset liability management. What was the bank's rating on liquidity?
Thank you, Representative Waters. My understanding is in the summer of 2022, although the composite rating was a 3, that is not well managed, the liquidity rating was a 2, which would have been satisfactory. And one of the things we're looking at in the review is how that synced up with the supervisory matters requiring attention and matters requiring immediate attention with respect to liquidity that had previously been issued. So we're looking at whether those standards were sufficiently stringent, whether the firm should have been downgraded further, and whether further supervisory steps should have been taken.
Whose responsibility was it, understanding the deficient rating, to do something?
The Federal Reserve is responsible for supervising this institution.
Did the Federal Reserve fail on that?
I think that anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
Thank you. Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, and you just responded in a way that says, yes, that is true, and perhaps something should have been done, and you're going to look further at that. Are you suggesting perhaps legislation to deal with that?
We're focusing in our review on our own supervision, ways that we could have done better as supervisors at the Federal Reserve, and ways that our own regulatory structure might have played a role with respect to the failure of this firm. So we're inward looking. It's a self-assessment, a prudent thing, I think, for us to do. It's what we tell banks to do. It's sort of the first thing you have to do to understand risk within your own institution, and that's why we're doing it.
Chair Barr, I wonder what it would take to receive a 3, 4, or 5 from a federal examiner. Well, I know the idea is to keep exam ratings confidential in order to prevent bank runs, but doing so also prevents this committee from understanding how well the Fed and other regulators are doing in rating banks. In the same way that stress testing results are public, are there ways we can make the supervisory process more transparent to promote discipline and accountability?
Thank you, Representative Waters. I think one of the things we're trying to do here today is to provide that accountability, and we'll do that in our report, which we'll do on May 1st. It will include confidential supervisory information. We normally do not provide that information, but given the fact that this bank failed and triggered a systemic risk exception, we're including that information, including exam reports.
Thank you very much. Very important issue. Chair Grunberg, Silicon Valley Bank was purchased over the weekend by First Citizens Bank and Trust Company. As you know, I wrote to you on March 18 about former SVB's Community Benefits Plan, which was intended to provide $11 billion in small businesses, housing, and community development support to communities in my home state of California and in Massachusetts. I understand that $2 billion in affordable housing and other projects may be lost or delayed in California because of the failure. Will Citizens Bank and Trust continue implementation of the former bank's community benefits plan?
The agreement between the community organizations in Silicon Valley in regard to the community benefits agreement was an agreement between those two parties. First Citizens will now be taking over Silicon Valley. There'll be an opportunity for the community organizations to engage with First Citizens. I know First Citizens has a community benefits agreement with community organizations where it's currently doing business. So there'll be an opportunity for the groups in California to engage with Citizens. And I would note Citizens is also subject to supervision under the Community Reinvestment Act. And so we'll be able to evaluate the degree to which Citizens is serving its communities pursuant to CRA.
Gentlelady's time has expired. We'll now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank the chairman, thank the ranking member for this prompt hearing after these weeks of tumult, and thank the panelists for being here as well. Mr. Barr, when were you nominated for your job?
I apologize, I don't have the date in my head. It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no Vice Chairman for Supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how's that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written
Yeah,
response.
if you get back to me, because what we're saying to my colleagues here is that from the turn of administration, we did not have a Vice Chairman of Supervision from January 20, 2021 until July of 2022, and that is precisely the time frames, colleagues, when this bank's business strategy went awry and was under this supervisory concern by the San Francisco Fed. So I just want to have that in the record. And when I look at the results of this bank and the UBPR, the call report data, and looking at your good testimony about the timeline that you disclosed, it appears to me that we have a lack of supervisory urgency here. You outlined that the trends in 2021 are what triggered concern by the Federal Reserve examiners, and I assume the state of California. We haven't heard from the state of California. We'd like to. But there was an exam in the summer of 2021, and then it took till the fourth quarter of 2021 to tell the bank we had some specific serious concerns, so that you met with the board then, not you, but the supervisors. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raised an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and they were noting? And we're gonna look carefully at that.
Yeah. I just was shocked with the business plan, way out of line with peer. You have matters requiring attention, which is a very low level, the lowest level editorial comment by a bank regulator. There was no proposal for a board resolution that I saw in your notes. So I look forward to the results of your comments. On this issue of Dodd-Frank versus S-2155, my reading of bank law, just those things are just almost not important compared to 12 USC 1818 on cease and desist, where the FDIC, the primary bank regulator, the state can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities
Right.
when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open to a full investigation, not only of the deposit insurance and not only of the supervisory process, but also look carefully at the resolution process itself?
Yes, Congressman.
And are you going to conduct that yourself, or would you work with us on that?
Well, we would certainly be prepared to undertake that review and be transparent with you in regard to it.
Something I want to see considered, and I argued this back in 2008 as a private citizen and banker, which is in the resolution process to consider non-bank buyers for these assets. Do you agree that's important? We should consider that?
Yes, it is, Congressman.
Thank you. I yield back.
We'll now recognize Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Mr. Barr, the rescue of depositors in Silicon Valley Bank demonstrates that regulators think banks like Silicon Valley pose a systemic risk to the system, just like Gypsy do. Mr. Barr, don't you think Category 3 and 4 banks should face the same rules as the mega banks?
Thank you very much for that question. We are looking at capital and liquidity standards for all large banks, including firms 100 billion and above. I still think a tiering approach makes some sense. It doesn't have to be the same rules for all banks, but we do need stronger rules for firms of this size. Stronger rules on capital and liquidity, I think, are going to be really important.
Mr. Barr, in my view, the decision to insure all depositors was a necessary and correct step. However, I am frustrated that time and time again we fail to regulate them like one, and as a result we find ourselves in situations like the one that we are currently in. Without proper regulations that account for the systemic risk profile of a bank, we are incentivizing bankers to search for yield and inviting moral hazard. Mr. Barr, the sudden and immediate collapse of Silicon Valley Bank demonstrates the vulnerability of banks and the broader system to interest rate rises. Yet, under our current capital rules, most banks are not required to recognize this risk, only GSIBs. Will the Fed rewrite its rule to require all banks to account for interest rate risk?
You raise an absolutely essential point, and one that we're very carefully looking at. We anticipate engaging in a notice and comment rulemaking process on capital rules with appropriate transitions, and that is one of the areas that I think would be important for us to consider in that rulemaking process.
So do you think that the rules passed under 2155 and written by the Trump administration need to be rewritten?
We're going to look as part of our review at not only our supervisory issues, but also at the regulatory structure that the Federal Reserve put in place in 2019 and see whether the size thresholds we use, the standards we decided to put in place, all of that is on the table. We're reviewing that. We're going to come back and provide an assessment of that on May 1st.
Thank you. And Mr. Barr, the Fed has been raising interest rates more rapidly than it has in decades in an effort to lower inflation. It appears that many banks were unprepared for this. Can you explain how the Fed's bank supervision staff coordinate with its monetary policy focused staff to ensure that banks are properly prepared for well-telegraphed shifts in monetary policy? Does the Fed see regulation and supervision as separate from monetary policy?
The whole of the Federal Reserve staff communicate very well together. As you noted, the monetary policy decisions were very well telegraphed. The decisions were essential to meet our congressional mandate of price stability and maximum employment. And we need to make sure that we continue to pursue that. We have separate tools that we use, of course. And as I said in other contexts, interest rate risk management is a core bread and butter issue in banking. It's not an esoteric issue, an exotic issue, a complicated issue. It's a straightforward issue, and the bank management failed to do that here.
Thank you. And during his news conference last week, Chairman Powell said that the FOMC considered a pause in the interest rate increases in light of the recent banking failures, but ultimately unanimously approved the decision to raise rates due to intermediate data on inflation and the strength of the labor market. How will the Fed balance its supervisory role with its monetary policy role as it considers future interest rate increase?
We have really all the tools that we need on the macroprudential and microprudential side to assess financial stability and bank safety issues. And as I said, the banking system overall is sound and resilient. Deposits are safe. On the monetary policy side, we're going to be looking at incoming data. We're going to be looking at changing financial conditions, and we'll really make a judgment on a meeting-by-meeting basis about that decision.
Thank you. Mr. Chairman, I yield back.
We'll now recognize Mr. Sessions for 5 minutes.
Mr. Chairman, thank you very much, and thank you to the witnesses for being here today. I think you see that this committee will work together, has questions, and would wish to hold you accountable, but I must confess to you, after hearing the questions that have taken place, I've heard none of you three accept real responsibility for your role in this endeavor. I've heard that you were aware of it the week of. I've heard that notice was given of oversight back in 21, that a frailty was noticed. I've heard us say that we used all of our tools. I've heard you say things like the FDIC will use all of its authorities. But I've not heard any of you three talk about a systematic failure to let the bosses know what's happening. I've heard you use, well, this got staffed and that got staffed and staff did this. I think this is a wake-up call to all three of you. I hope it's a wake-up call to your organization, that evidently they can see these bread and butter failures back in 2021, but evidently nothing realistic ever occurred to avoid what seemingly anybody that's a professional banker could see. I've seen excessive regulatory oversight by this administration across the board. I've seen a lot of what I would call inattention by decision makers. So I would specifically tell you that we will drill down on and need to know more about the recommendation for systematic exception that was invoked. In other words, that was invoked by presumptively the people at this table, and yet it took all this time to filter up before you were even aware. Failure was occurring, and then you were given notice. So I would hope myself that there would be some inward thinking about your actual roles. Instead of staffing everything and waiting for it to bubble up to you, that there should be hooks in place. I spent 16 years in the private sector, ran a large organization, over 700 employees. I had more than a fiduciary responsibility, I had a managerial responsibility to report up the things that we saw to a very large organization. And I believe by and large those people welcomed my feedback and set ourselves up for that. So take the remaining minute and 50 seconds and give me some inward thinking, because I heard no one say, we were part of the problem. We need to look at us being part of the problem, and we need to be a part of the solution, because, as was noted, this will be paid by all banks across the country of the FDIC. Please. Mr. Barr?
Thank you very much, Mr. Sessions. I agree with you. I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that. And I think we are going to be unflinching in our review about that.
Does that include your role?
Absolutely. Absolutely. And I'm here today to be accountable to you for that purpose.
Well, accountable is one thing, but coming back and actually admitting that you were part of the systematic failure is an entirely different process. People say, well, we'll hold accountability, but actually it's banks that are across the country that play by these rules and offer this money are the backstop. And while I don't want to argue against that, I do want to say I believe there's lots of room to say someone should have caught this as early as and done something back in early 22. Chairman?
Congressman, I really don't mean to shirk responsibility here. I think we share responsibility. I think bank management had responsibility. I think we as the regulators of the institution had responsibility. I think we're going to conduct reviews to get the facts as to what occurred and a measure of internal as well as external accountability. My own sense here in terms of the supervision of these institutions from my perspective is that both agencies, and I would include ourselves, were aware that there were issues at these institutions and trying to address them through the supervisory process. It's also my judgment, I think, and we're going to conduct a review to get all the facts here, if I may say.
The gentleman can answer the rest for the record. With that, we'll now recognize Mr. Sherman of California for 5 minutes.
Due to Dodd-Frank, our banking system is strong. Our regulators avoided a crisis by quick action this month. But the solution was not free. Some $22 billion of special assessments will be imposed on banks. That will lead to lower rates on certificates of deposit, perhaps 0.25%, perhaps 1/8%. And our entire economy has been hurt. It's been rattled by what happened this month. Our bank regulatory system has some real flaws. It's an undemocratic system in which FASB writes the accounting rules and doesn't even claim to be part of a democratic government. The Federal Reserve Board's regional banks, it's not one person, one vote, it's one bank, one vote. The bankers vote on who's on the regional board, and the bankers of my state elected the CEO of Silicon Valley Bank. Banks get to pick their regulators, state or federal, holding company or no holding company, Fed or OTC. They can use regulatory arbitrage, and every regulatory agency knows that if it gets a reputation of being too tough, the banks can flee and go to one of their regulatory competitors. Our accounting system for banks is absolutely perverse. If you make a Main Street loan, you're penalized under the CECL system. And you will always list that loan on your balance sheet as being worth less than you paid for the note. If you instead go to Wall Street and buy long-term bonds, you are rewarded. If the bond goes up in value, you can sell it or classify it as available for sale and recognize a profit and justify a bonus. If the bond goes down in value, you can hide it by listing it as held for maturity and list it at the original purchase price on your balance sheet, even though you know it's worth 20 or 30% less. The crypto billionaires fanned the flames because they understood that if they can besmirch our banking and dollar system, crypto goes up, and they've made tens of billions of dollars. Silicon Valley Bank could have saved itself in 2022 by hedging its risk or selling its long-term bonds, but they knew that would cut profits and bonuses. They decided to take the risk, and here we are. And of course, our clawback provisions are inadequate. There's $600 billion of unrecognized losses on the balance sheets of American banks. That needs to be juxtaposed with the $2.2 trillion of capital American banks have. So we're overstating the capital of our banking system by perhaps a quarter. Mr. Barr, particularly watched your Senate testimony in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice. And interest rates go up, interest rates go down. Certainly the Fed in auditing banks ought to know that, especially when this is not a 100-year event. Interest rates go up, interest rates go down. I mean, 2023 has its peculiarities, but it's particularly ironic. It's the Fed that's raising the interest rates, and then the Fed that's not examining banks to see if they can survive if interest rates go up. The concern we all have is, are there other banks that could go under because they invested in long-term bonds that aren't worth as much as they paid for them? So I'll ask Mr. Gunberg and perhaps Mr. Barr, are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
Mr. Gunberg, I know that you're going to be giving us a report about possibly expanding FDIC insurance this spring. I look forward to it. And I hope that you would consider $3 million of coverage, but only of non-interest bearing accounts. Because when a bank is used as a utility for a checking account, we need that coverage. If people are making investments, we ought to be a little bit more careful, and I'll yield back.
We'll now go to the Subcommittee Chair on National Security, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, for more than a year now, Financial News has focused on Fed raising rates. There isn't a person in the financial services sector of the country that hasn't heard about it on a seemingly everyday basis since the beginning of 2022. Well, it has been the fastest rate increase in our country's history, which I believe is probably too fast. Chairman Powell has made his intentions very clear. No banks should have been caught off guard by rate increases. In fact, the Federal Reserve is in the same position themselves. Mr. Powell was here a couple weeks ago and acknowledged that his bond holdings have got them, and the interest rate situation that they have is actually losing money as a result of this himself. So it's even more surprising that a $100 billion bank's not considering the effect of rate increases is, in fact, according to your testimony, the Fed staff hasn't presented to the Board of Governors with its impacts on rising rates until mid-2023, February of 2023, just last month. So are you telling me that every time the Fed raises rates or drops rates, there is no economic analysis done on the impact on our economy?
Mr. Lutkemeyer, I was referencing that particular meeting because the staff.
No, that's not my question. My question is, does the Fed, before it raises rates or lowers rates, does it have an economic study done by its economists? They've got a team of economists there. Do you have an economic analysis done of the impact of that? Mr. Gabarino, would you please move to your right, please? Thank you.
Yes, we evaluate all the economic conditions.
You get a report from your
financial
economists
conditions
that the
when
Fed,
making any interest rate
that the
decision.
Fed, that you do, does the Fed board get a report from their economists saying what the impact of their rates will be on the economy? Yes or no?
Yes, we get staff forecasts that forecast the expected impact on the economy of rate decisions.
Okay, how come you made a specific mention of this in your February report then? Why did you specify that you got the rate?
That's what I was trying to explain earlier. I mentioned that because the report specifically called out Silicon Valley Bank. We regularly discuss interest rate problems. Interest rate risk is an important part of supervision and a bread and butter issue.
Okay, a bank this size, normally you'll have an examiner or two or a team that is in there on a daily basis. Was there an examiner or team of examiners in Silicon Valley Bank on a daily basis?
The team consisted of about 20 full-time equivalent staff at the San Francisco Federal Reserve Bank.
They were not in Silicon Valley then?
I don't know precisely the extent of their in-person meetings versus their remote analytic work.
Okay, that's another problem that we have to talk about, having all this work off-site whenever they need to be on-site, being able to have access to the daily data. But as a result of this, and I'll follow up on some of the questions that have been asked before, but ask them a little bit different way. You knew that we had an interest rate risk problem and a liquidity problem. You acknowledged it all the way through from 2021. It's been established this morning. You have examiners in the bank are watching it on a daily basis. And you know that you've had some reports that say we need to take some action. Why was no action requested or not forced on the bank?
There was action requested of the bank in the matters requiring attention and matters requiring immediate attention.
Why were they not enforced?
I think that's a question for our review. We don't know. I don't yet know the answer. Could the staff have escalated more? Should they more? What were the interactions with the bank? That's all part of the supervisory record that will be in the May 1st report.
Well, that begs the question then, Mr. Barr. If you think you need more rules and you're not even enforcing existing ones, why do you need more rules? I don't think we need to look at more rules until we figure out which rules were not being enforced, what messages were not being delivered to the bank to be able to do your job. At that point, then we can take a look and see what we need something else. But for you to make the statement, we need more rules and regulations, how about enforcing the existing ones first?
We're going to be looking, as I said, at our own supervision under the existing framework, ways in which existing rules.
Okay, very quickly, I got one more quick question for you here. This situation points out a very unique situation because of the new social media, the world of instantaneously being able to do some things. I have grave concerns because within a less than 2-day period, $42 billion rolled off the books here, basically as a result of a Twitter little informational thing. It begs the question down the road here, Mr. Barr, it opens up the possibility whenever you have a bunch of significantly distressed banks that there could be a short sell on some of these things that could be out there. We need to be talking about that. Are you thinking about that at all yet?
Yes, I think you're raising absolutely important and critical questions about the role of social media, the role of networks, depositors with each other, and the
you're working on a real-time payment system that's going to be ripe for a problem like this with Twitter if we don't fix that.
Time's expired. You can
Thank you, Mr.
answer for
Chairman.
the record. We'll now go to Mr. Scott of Georgia for 5 minutes.
Thank you very much, Vice Chair. We know that this was basically the fault of the management. But what we want to know is, where did the Fed go wrong? Where did the Fed go wrong? And specifically, did the Fed miss red flags or ignore warning signs that were brought to you by your staff months or even years before the collapse?
Thank you very much for the question. We do have in the supervisory record staff reaching out to the bank, highlighting these problems. As you noted, in the first instance, it's bank management's responsibility to fix those problems. They didn't do so.
Well, Vice Chair, is it true that the San Francisco Fed, which supervised Silicon Valley Bank, sent multiple warnings to the bank's management about the risk it was taking, including its substantial holdings of treasuries and other bonds that were steadily losing money as interest rates rose?
Yes, the supervisors pointed out to the banks that they were exposed to interest rate risk and liquidity risk, and that they didn't have the risk management in place to address those.
And
the bank failed to fix those problems.
And how often did Fed staff share with the Board of Governors that rising interest rates were threatening the finances of some banks, and in particularly the risk-taking at Silicon Valley banks?
My understanding is that the particular issue with Silicon Valley Bank did not rise to the level of the board until mid-February of this year.
And the other question is
the Board of Governors, I should say.
Why do you think that the full extent of the bank's vulnerability did not become apparent until it was too late? Especially when the FDIC data was showing that SVB was doubling in size in 20 and 21, doubling in size within 12 months. Was that not a red flag?
No, I think you raised, I apologize, I didn't mean to cut you off there at the end. I think that one of the things we're looking at is that the way the Federal Reserve's regulations set up the structure for approach to supervision treated firms in the 50 to 100 billion range with lower levels of requirements, and had a phase-in period for firms that got above the 100 billion line. That meant that their transition into those higher standards took a long time. So by the time the group was actually looked at in an intense way by the group in the large and foreign banking organizations team, a lot of that growth and a lot of that activity had happened. And so in a sense, it was very late in the process. And that's one of the things we're looking at in our review.
Good. And I want you to know that I appreciate your recent announcement that a formal review into whether the Fed failed. It's good to admit failure. That is the first step for correcting the problem. And whether the Fed failed to properly oversee Silicon Valley Bank will take place, and more importantly, that it will be shared with us in the public. Is that true?
Yes, that's absolutely right. We thought that it's really important as a first principle of risk management for us to do our own self-assessment. We have a team of people working on that self-assessment who are not involved in the supervision of Silicon Valley Bank. We're going to make all of those findings and recommendations public on May 1st. And let me also say we welcome other outside reviews, as this body is doing today, and others will as well.
Thank you very much, Vice Chair.
The gentleman from Michigan, Mr. Huizinga, the chair of the Oversight Subcommittee, is recognized.
Thank you, Mr. Chairman. I'm going to quickly move ahead here. A loss in confidence in the banking system is a loss of confidence in regulators in many of our minds. Regulators seem to have had the tools at their disposal to prevent these failures from happening. They seem to have missed that. We're going to be exploring that. As chairman of the Oversight and Investigation Subcommittee, I find it necessary to reiterate how important the congressional oversight is, and that it's a constitutional authority that we have, and frankly, an obligation that we have to maintain the well-being of our system of government. Mr. Barr, you just had said it was appropriate for outsiders to do their independent reviews. That's what we are trying to do here today. You were authorized, though, on March 13 to do your report, correct? Who authorized that?
Chair Powell and I made...
Okay, that's all I need to know. Chair Powell authorized you?
Chair Powell and I jointly made the decision
Okay.
for me to proceed
Great.
with this.
Is it your understanding as well that under Dodd-Frank, anytime 13.3 is invoked and utilized, that the GAO is also supposed to do a report?
I'm not familiar with that precise provision, but it makes sense to me that GAO should do a review.
Okay. And do you know when GAO is going to be starting their report?
I respect the independence of the GAO and suggest
Great.
that.
Page 2 of your testimony, you said that the mayor report will include confidential supervisory information. Will you be providing that CSI to the GAO?
Yes, consistent with normal practice.
Right. Well, we might have to unpack that a little bit. Will you also commit to me and this committee and to the chairman that you will provide this committee with all those same related confidential supervisory information needed to appropriately assess on our end what happened?
Yeah, the same information in the May 1st report will be available.
No, not in the report. You're giving if you're giving that supervisory information for the GAO to do their review, not before you review it yourself and decide what is appropriate and not appropriate. I thought you just said that you would be providing GAO with all of that data and information that you will be using to make your report. Is that correct?
We will make the information that we are using for the report available to you and to the GAO. And
okay, so we have your commitment that you are going to be providing us with all of that raw, confidential, supervisory information so that we can do our job.
The same information that we'd use for the GAO and for the public report.
I'm not looking for the report, though. I want to make sure we've got the information. I'm trying to make sure that our semantics aren't getting played.
We follow our.
I will accept the answer that you are going to give us the exact same information in a timely fashion that you are using for your report. Fair?
Yes.
Okay. All right. Mr. Grunberg, I want to touch on the Treasury's commitment. I'm sorry, the FDIC to look at what was going on there. The same question really is to you. Will you commit to providing the committee with all related confidential supervisory information that is needed for us to assess?
Yes, Congressman. One, I think you have the authority to compel that information. We'll be responsive to you.
Okay. Timely manner is the key watchword here. Between myself and the chairman, Chairman McHenry, we have a number of requests to all of you. Ms. Lang, I want to touch on this to obtain the information. FSOC was convened on both March 10, March 12, and March 24. Has FSOC met since March 24?
They have not met since March.
You have not, okay. So it was reported that Secretary Yellen convened these officials via video conference, is that correct?
Yes, I believe there
were part of
two
that?
FSOC meetings.
Okay, and you were part of that?
I was part of the second one. I was not part of the first one.
You were not part of the 10th, okay.
I was not. That was the evening, I believe, we announced. I was not part of the March 12th meeting.
Were minutes taken at those meetings?
By normal process, minutes would have been taken.
And will we have access to those minutes?
Yes, they are released according to...
Before they're released, because we only have minutes from December 22. There is nothing that has been released publicly since December 22.
That is correct. I believe the process is minutes are released following the next formally scheduled FSOC meeting.
Only if formally scheduled.
We can come back to you on that, when they will be released.
So we have to wait till the next formally scheduled time to get those minutes.
I understand that's the process, but
we'll be following up in writing. Thank you.
We expect a written response for that, Undersecretary. I will now recognize Mr. Lynch of Massachusetts for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member, for holding this hearing. I want to follow up on Ms. Waters' line of questioning. Prior to its collapse, Silicon Valley Bank was a major lender and investor in low and moderate income housing in Massachusetts, in my district. In large part because it acquired the Boston Private Bank and Trust Company back in 2021. So that includes not only deposits, but construction financing, permanent financing, mortgage lending for low and moderate income home buyers, equity investments, and direct purchase of tax-exempt bonds for affordable housing development. So right now I've got 18 affordable housing developments in my district and on the outskirts of my district, currently in construction in Massachusetts. And they depend on the fulfillment of outstanding debt and equity commitments that were made by Silicon Valley Bank. So these developments, and this is the back of the envelope, I'm sure there are more, but I have 754 homes, including 702 affordable homes for residents with low incomes, and 118 homes for residents with extremely low incomes, as well as workforce housing. So while the vast majority, here's the thing, while the vast majority of high net worth investors and depositors at Silicon Valley Bank have been held harmless, they've been rescued. The First Citizen Assumption Agreement is completely silent on the status of these low-income victims. And that is a problem. That flies in the face of your mission and mine. And so, Mr. Grunberg, now, and I appreciate all three of you and the work. You worked quickly once you saw the problem. And I find great fault with the reckless management on the part of Silicon Valley Bank in that they concentrated so much risk and there was an absence of meaningful risk management. But we have a problem. And while the bank crisis might be over, it's not over in my district with all these families, all these low-income families that are struggling. You know, I got cities like Brockton, Massachusetts. We got a great mayor there doing a wonderful job, and they're all going in the right direction, and as well as Boston and Quincy and others. But we need help. We need to resolve this. So, Mr. Grunberg, I need a commitment from you, sir, that you need to come to Brockton. You need to come to Brockton in my district, and we need to work this through so that we provide the kind of protection for low-income families, a lot of them families of color, many first, they're first-generation immigrants, and, they need help. And I think you and I need to be there, and I'll get my mayors together and these 18 affordable housing development managers, and we'll try to get this done. But can I get your commitment? Any thoughts on that?
Yeah, Congressman, I'd be glad to do that and follow up with you as First Citizens takes over, is in a position to continue to serve the customers of the former institution and work with you in regard to the community issues you just described.
That's great. I'm very happy to hear that. There's something new and different, though, in this collapse. There was a concentration of risk on the part of Silicon Valley Bank. They catered to early stage startups which have a high rate of failure in the first place. They're very skittish, so those aren't core deposits that are going to stay through any period of unsettled economy. And then on top of that, you have panic that is driven by social media. In many cases, you had venture capitalist firms telling their clients at that bank to get the heck out. So the speed at which this happened was a matter of hours. And again, I commend you on the speed at which you acted. But is there something more that we need to be doing now because of the velocity of money? People can move their money out like that. And are we equipped? The FDIC has a long and strong history, but is is something new and different needed to protect us from that phenomenon?
Congressman, I think that's an important question to ask. I think we are dealing with a different environment, and the point you raise in terms of how quickly money can move, what the technology enables now that exceeds what's occurred in the past is a new risk factor that we have to think about.
I would ask the panel to all respond to the gentleman in written form about that very, very important subject. I will now recognize Ms. Wagner of Missouri for 5 minutes.
I thank you, Mr. Chairman. And Vice Chair Barr, we're going to go very quickly here, so I would like some succinct, brief answers if we could. Vice Chair Barr, referring specifically to Federal Reserve supervisors, do you know how many citations, specifically the matters requiring attention, MRAs, and matters requiring immediate attention, MRIAs, that were issued to Silicon Valley Bank regarding its management of liquidity risk? Microphone and a number. Do you know how many?
In November 2021, there were 6 MRAs and MRIs on liquidity. In the fall of 2022, there was an additional MRA on interest rate risk modeling. I think I misidentified inadvertently yesterday as an MRIA, but as an MRA.
That's fine. I don't need you to go through all of them. We've got 6, maybe 7 of these citations that were given. Yesterday, you were asked about an MRIA that was issued in the fall of 2022. You stated that the MRIA was issued, quote, based on the inaccuracies of their interest rate risk modeling. Essentially, the risk model was not aligned with reality. This is your quote.
Yes.
Did the supervisors provide the bank a timeline to remediate this misalignment? Since changing an interest rate risk assessment model seems to be something that could be done very quickly.
Yes, my understanding that there were time limits associated with each of these MRAs and MRIAs, but I don't have the information.
Really? Okay, well, clearly those alerts were ignored at the bank. Why didn't the Fed consider escalating any of these issues into a cease and desist order or other formal enforcement action against the bank to require senior management and the board of directors to remediate these serious deficiencies?
I think you raise a fair point, and we will be looking into that.
I certainly hope so. Vice Chair Barr, in your testimony you stated, quote, the failure of SVB illustrates the need to move forward with our work to improve the resilience of the banking system. For example, it is critical that we propose and implement the Basel III endgame reforms, which will better reflect trading and operational risks in our measure of banks' capital requirement needs. Sir, I strongly disagree. These reforms will result in additional costs on consumers, on businesses, and investors. I'm gonna go real quickly here. Was trading risk the reason SVB had almost 94% of its deposits uninsured?
No.
Was trading risk the reason SVB did not have a risk officer for nearly 9 months last year?
I do not believe that that was the focus of why there was not a credit risk officer.
No, trading risk was not the reason. Was trading risk the reason SVB had 51% of its deposits in the tech industry? Yes or no?
Not to my knowledge.
You know, I fail to see how SVB illustrates a need to implement Basel endgame reforms, particularly as it relates to trading risks. Can you show how trading risk directly resulted in SVB failure? Or, sir, are you just looking for any reason, correlated or not, to justify increasing capital requirements for our banks?
I think it's really quite important that we strengthen capital and liquidity requirements in the system. It's something I've been working on since arriving at the board in July. And I think that the work that we're going to do, that we will propose through notice and comment rulemaking, will make the financial system safer and sounder. That reduced risks that firms such as SVB and the—
You stated that yesterday that our banks are well capitalized, did you not?
Yes, I have been consisting in saying that both that the system is strong, but that also we need to think about stronger capital rules, and I think that's appropriate given the.
Well, we're going to have a hearty give and take on this. You know, I want to say this in closing. Despite U.S. regulators having clear knowledge of insufficient risk management, it seems that the examiners and your supervisors were asleep at the wheel, while signs that Silicon Valley Bank was heading towards a collapse were staring them right in the face for many, many months. Vice Chair Barr, I look forward to the release of your review of the supervision and regulations of Silicon Valley Bank so we can dig in some more on May 1st, and I hope that it provides more clarity to the events leading up to these bank failures. I thank you, and I yield back the balance of my time, Mr. Chairman.
We'll now recognize Mr. Green of Texas for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member, the witnesses for appearing. Witnesses, you have all made the case for mismanagement at Silicon Valley. If you disagree with this statement, please extend a hand into the air. Let the record reflect that all witnesses agree that mismanagement was occurring. I have before me a news article from what is perceived to be by many a reliable source, CNBC. The style of the article is, that would be the title, the style is Silicon Valley Bank employees receive bonuses hours before government takeover. Hours before government takeover bonuses. It's also alleged by other sources that these bonuses could exceed $100,000. Mr. Grunberg, is it true that hours before the takeover of the bank, before it was seized, that bonuses were accorded employees?
Congressman, since we weren't the supervisor, I wouldn't have that direct information. I'm sure we could get it for you, or the Federal Reserve could provide it.
I welcome the intelligence from the Federal Reserve.
But if I could just make an additional point, which is the FDIC is under a legal obligation after the failure of Silicon Valley to conduct an investigation of the conduct of the board and the management of the institution. And if misconduct occurred, we do have authority to impose civil penalties, including civil monetary penalties, restitution, and to bar individuals from the business of banking.
Thank you.
We do have some significant authorities and responsibilities.
Thank you. I yield to the FDIC. Excuse me, to the Fed.
Thank you very much, Representative Green. The board also has the authority.
Without the authority right now, just tell me, did the bonuses, were there bonuses given out hours before the bank was seized?
I have seen reporting of that, but I'm still trying to chase down the facts. Our enforcement team has the ability to go after actions against individuals.
So you're saying you do not know, but you have heard that this is the case?
Yes, I do not have the supervisory record of that to know, but I've seen reporting of that, and we're looking into it.
For the moment, let's just assume that Bank X hands out bonuses. Management has failed to do its job. Do you have the inherent or accorded or statutory power to claw back those bonuses?
We have the ability to pursue actions for individuals who violated the law.
May I kindly ask about clawback of bonuses? Can you claw back those bonuses?
Under our authority, if there are violations of the law or unsafe or unsound practices or any breach of fiduciary duty, we can get restitution we can get civil money penalties, and we
So
can have
should
a
I
prohibition
assume
of
that your answer is no, you do not have the authority to claw back those bonuses?
We don't have generalized clawback authority.
You do not. All right, I see a hand raised. Mr. Gruenberg, please.
Just to try to respond directly to the question, we do not have explicit the FDIC does not have explicit clawback authority under the Federal Deposit Insurance Act. We have that authority under the Dodd-Frank Act in regard to failures under Title II, but we do not have that under the Federal Deposit Insurance Act. So in considering additional authorities that Congress might provide, that might be something worth considering.
Thank you, Mr. Gruenberg, because that's exactly where I'm going. We live in a world where it's not enough for things to be right, they must also look right. And it just doesn't look right for hours before the bank is seized, bonuses to be accorded employees, and some of these bonuses total more than $100,000.
Gentleman's time has expired. We'll now recognize the Chair of the Financial Institutions Subcommittee, Mr. Barr.
Thank you, Mr. Chairman and Ranking Member, for holding this important hearing. And Vice Chairman Barr, true or false, Silicon Valley Bank experienced rapid asset growth in a short period of time?
Yes, that's correct.
Silicon Valley's rapid growth was fueled by an extremely high concentration of deposits from a single sector.
Yes, that's correct.
Silicon Valley Bank became overdependent on an extremely high percentage of uninsured deposits.
Yes, that's correct.
Silicon Valley Bank failed to hedge the risk of holding long-duration securities in a rising interest rate environment.
My understanding is at one point they had hedges, and those were not in place at the time they failed.
And that was apparent to the Fed.
Yes, it was apparent to the Federal Reserve.
Silicon Valley Bank had no chief risk officer for 8 months before its collapse.
Yes, that is correct.
Was the San Francisco Fed unaware of any of these basic facts in the months leading up to its failure on March 9th?
Not to my knowledge.
So nothing in the existing regulatory framework concealed these basic facts from the San Francisco Fed, which had responsibility of supervising this bank.
The regulatory structure doesn't conceal facts. It may have an effect on how supervisors act with respect to those facts.
True or false, Silicon Valley Bank was subject to enhanced prudential standards under Dodd-Frank as amended by the 2018 bipartisan regulatory relief law.
The Federal Reserve supervisory structure did not apply most enhanced prudential standards to the firm. It did have some enhanced prudential standards once it became subject to those standards after it passed the average at the 100 level.
Before it passed that $200 billion threshold, when it passed the $100 billion threshold, it was under 2155, the bipartisan regulatory relief law, under Section 401A1C of that law. The Fed could have applied enhanced prudential standards to Silicon Valley Bank. Is that correct?
Under the 2019 rules that the Federal Reserve put in place, most enhanced prudential standards did not apply to the firm.
But wait a minute, I don't know about that, because under 401A1C of that law, the Fed, by order or rule, could apply enhanced prudential standards to banks not above $200 billion, but above $100 billion in assets on a one-off basis.
Yes, the legislation provided the Federal Reserve with ample discretion. The way that discretion was implemented in 2019 was with a rule, and that rule provided.
But by order, and reclaiming my time, Vice Chair, by order, the Fed could have applied enhanced prudential standards before the bank reached the size it did by February of 2023. My point is, it doesn't seem appropriate to change the tailoring rules for all banks to account for a lapse in supervision by the Fed and the inability of the Fed to deploy enhanced prudential standards to firms when it's currently able to do so under existing law. And Mr. Barr, as you and I have discussed, and as we agree, we need to preserve the diversity of the financial ecosystem here. The Fed had all the existing tools it needed to supervise this bank and apply those enhanced prudential standards. I think pushing a one-size-fits-all or reimposing a one-size-fits-all regulatory regime on community and regional banks, especially regional banks under distress right now, would result in fewer of those institutions, more consolidation, and less competition for too-big-to-fail banks. Mr. Director Grunberg, the vast majority of community banks in my district are well managed, and they actually understand how to manage interest rate risk in a rising interest rate environment. And since the failure of Silicon Valley Bank, those Kentucky banks and their customers have been asking me why they should have to pay an assessment for your rescue of Silicon Valley Bank with 100% guarantee of deposits of largely wealthy, sophisticated depositors at Silicon Valley Bank, some of whom apparently cared more about the bank's commitment to environmental sustainability than their capability to be good stewards of their deposits. I think this is a legitimate question. And I also think it's a good question whether invoking the systemic risk exception to the least cost resolution mandate under the Act was in fact the least cost solution. After all, your decision to cover all of the uninsured deposits cost the Deposit Insurance Fund an estimated $20 billion. Will you commit to using your authority under 12 U.S.C. 1817 to establish separate risk-based assessment systems for large and small members of the Deposit Insurance Fund so that these well-managed banks don't have to bail out Silicon Valley Bank?
Certainly willing to consider that, Congressman. And as I indicated, we are going to be preparing a comprehensive review of the deposit insurance system. So we'll come back to you and glad to engage with you.
Gentleman's time is
Thank you, Ayo.
expired. We'll now go to Mr. Himes of Connecticut for 5 minutes.
Thank you, Mr. Chairman. It's interesting to me to listen to my friends on the other side of the aisle who ordinarily spend all of their time trying to defund, destroy, and denigrate your organizations, now hold you entirely responsible for where we find ourselves today, despite activities within the bank that I think we all agree, and Mr. Barr, you have said were on the verge of outrageous. So I'd like to begin by thanking all of you and your organizations for the intense and sleepless actions you took beginning on March 9th. I don't know if you acted perfectly, and you don't know if you acted perfectly, but we all know that today the financial system appears to be stabilized, and we certainly know that Congress is not lighting itself on fire, crafting a massive publicly funded bailout as it was in the fall of 2008. I hope that we've dispensed with the absurdity that it was Silicon Valley's woke activities that drove this failure. And while I don't necessarily agree, Mr. Barr, with your predecessor's statement that blaming the bipartisan 2018 reform law is so nonsensical it isn't even wrong, the truth is that Silicon Valley Bank was crawling with supervisors and regulators who had been raising the alarm for a long time. And that's what's interesting to me about this whole episode. It was not a surprise. It wasn't a surprise to the regulators and supervisors who had been raising those alarms for years. It shouldn't have been a surprise to the management team who had been the target of those alarms. By the way, just as a side note, it was a surprise to the Wall Street research analysts who were paid very good money to evaluate Silicon Valley Bank. 24 Wall Street analysts cover Silicon Valley Bank. 11 had buy ratings on it, 11 had hold ratings on it. Only one analyst rated it a sell. More seriously, the credit rating agency, S&P Global, rated Silicon Valley investment grade right up until March 10th when it announced that it expected a bankruptcy. There's an uncomfortable echo of 2008. By the way, Mr. Chairman, I'd like to insert for the record unanimous consent, a remarkable article by Professor Raj Gopal of the Columbia Business School, which elaborates many of these points that I'm making.
Without objection.
The facts have been put out there pretty comprehensively. In 2021, 2 years ago, the Fed review results in the finding of serious weaknesses, the issuance of 6 matters requiring attention and 1 matter requiring immediate attention. July of 2022, the full supervision review rates the bank deficient. That's 7 to 8 months before March's meltdown. Early 2023, there's a horizontal review. Again, the word deficient. So, and by the way, that's complicated for most people to understand. Here's something that's not complicated for people to understand. As far as I can tell, Silicon Valley Bank had precisely 1 individual who was a banker on their board, Mr. Thomas King. The risk committee of this bank, which tripled in size in 2 years, had no one. The risk committee had no one on the committee with any significant banking experience. So, Mr. Barr, I'm going to put you in an uncomfortable position and say, clearly what we have here is a gap of time and a failure of action between the deficiency rating in July of 2022 and the meltdown in March. That's a long period of time. So I'm going to ask you for ideas, not necessarily good ideas. I understand that you're going to be uncomfortable to make recommendations, but clearly we need to tighten up the process by which good things happen after a finding of deficiency. So should that be left in your regulator's discretion, or should we act in such a way as to make actions mandatory subsequent to a deficiency rating?
It's a great question you raise, and one that I think is appropriate for reviewing both by you and by us. I think that we need to put in place risk mitigants and incentives that are much stronger, faster in the supervisory process. That's one of the things that we'll be looking at in the review. But I do think that in instances like this, where it is such a fundamental issue, we need to have risk mitigants in place that are ordered by the supervisors quickly.
So I'm just going to make this observation as I run out of time. As we all saw, one of the problems here, and one of the new things here, were the chat rooms and the speed by which deposits could be withdrawn. And billions of dollars went out the door because of these devices. So I'm not convinced that giving humans who operate in human time additional authority is going to do the trick here. I think we need to think about automatic mechanisms, and that may require statutory change. Automatic mechanisms that when a finding of deficiency or other adverse observations have been made, kick in automatically, perhaps after some cure period, but this was a meltdown that happened at the speed of light, and humans with discretion is not going to solve it in the future.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to repeat myself a little bit, what you've heard today, but when I talk to community banks in my district, and in full disclosure, I'm a car dealer, and I talk to them a lot and owe them a lot of money. One of their top worries right now is being left to foot the bill for the failures of Silicon Valley Bank and Signature Bank. Community banks, which most of us live by, should not be liable to pay for the rescue of larger banks that gambled and made a risky bet. So community banks are relied upon Main Street, America, to be a lifeline and provide crucial banking services to small businesses. So these smaller banks, which we all need to have, are some of the most trusted institutions in the financial industry. So Mr. Grunberg, you talked about it before, but could you elaborate if smaller community banks in Texas, where I'm from, will be left responsible for bailing out the failed banks in California and New York, which we don't even know where they are?
Thank you, Congressman. I'm keenly sensitive to the concern. Let me just say, under the law, the FDIC is required to impose a special assessment on the banking industry to recover any cost to the Deposit Insurance Fund from covering these uninsured deposits. And we have to do that by a notice and comment public rulemaking, which we're going to do in May. And just to be clear, the law gives the FDIC authority to consider the types of entities that benefit from any action taken or assistance provided, so that the FDIC does have discretion. And let me just say, without forecasting what our board is going to vote, we're going to be keenly sensitive to the impact on community banks.
Take a look at it, because we all know that what they'll do is pass the cost on to someone like me. The Federal Reserve was supposed to be the primary supervisor over Silicon Valley Bank, but from all we've seen and heard today, they failed to do their job, and it's been reported that Silicon Valley's bank risk practices were on the Federal Reserve's radar. We've talked about that for over a year. In 2022 alone, Fed supervisors issued 3 findings on SFB's ineffective board oversight, weakness in their risk management, and flaws with the bank's internal audit function. So it should raise major concerns that the Federal Reserve, who is tasked with regulating and overseeing banks, knew about Silicon Valley's risky practices far more than a year and failed to take any corrective action. Now, Mr. Barr, what actions, if any, did the Federal Reserve take, and you talked a little bit about this, after issuing those risk findings, and how did the Fed Reserve become so complacent on its supervisory role and miss these warning signs? And I think that's what people across America really want to know.
Thank you very much for the question. My understanding is that the supervisors identified the issues, they brought them to management's attention. The response clearly was not an effective response. Bank managers failed to manage the firm in an appropriate way. They didn't manage their interest rate risk and their liquidity risk well, even though it was pointed out by the regulators. And I do think it calls for a heightened need for more aggressive supervisory action to take care of these problems.
But you all missed it too.
I'm sorry?
You missed it too.
The supervisor staff were aware of the underlying issues. I think all of us were caught incredibly off guard by the massive bank run that occurred when it did on March 9th and 10th. The scale and speed of that, $42 billion going out the door Thursday afternoon. It was expected by the bank that $100 billion more would go out the next day. That's just an extraordinary scale and speed of a run that not anything I had ever seen before.
Okay, out of all the banking supervisors, I would expect the Federal Reserve, and most of us would, to be the most aware of the impacts increased with rate hikes would have on the value of securities for banks. However, the Fed has stress tests, which we talked about, which are conducted to determine how large domestic banks would perform under hypothetical and stable economic scenarios, currently does not test for the problems that caused Silicon Valley Bank to fail. SFB failed because of inflation, rapid increase in interest rates, and loss in value of government bonds. So even if SFB had been subject to testing, it would not have led to the changes that could have prevented their failure because the Federal Reserve is asking the wrong questions and not running scenarios that ultimately led to SFB's downfall. So we'll correct Mr. Barr. How can the American people trust the Federal Reserve if you are not testing for all scenarios? How was the Federal Reserve so far off? That is a question that everyone asks again.
I think that the Federal Reserve should use multiple scenarios. That's one of the reasons why I proposed that for this year's test. It includes a rising interest rate environment for the trading book. I think multiple scenarios makes a ton of sense and should be done.
You know, that saying, they can get it right 100 times. You got to get it right once. So you got one crack at it. So thank you very much.
Gentleman's time has expired. We now recognize the ranking member of the Digital Asset Subcommittee, Mr. Foster, Illinois, for 5 minutes.
Thank you. As you know, 12 years ago during Dodd-Frank, a number of us put a lot of effort into specifically authorizing U.S. bank regulators to put contingent capital requirements into the capital stack of large banks. These can sort of be thought of as a sort of privately funded insurance policies that large banks are forced to carry that pays out if a bank gets into trouble and automatically injects capital into a struggling but not yet failed bank. Now, for the last 12 years, U.S. bank regulators have completely ignored this authorization from Congress, which I have complained about in numerous hearings. But in the last 12 years, European bank regulators and others have used contingent capital successfully. And so now I believe that we have a lot to learn about two side-by-side bank failures. First, Silicon Valley Bank, a large bank by some measure, but with total assets less than 1% of U.S. GDP, and Credit Suisse, with total assets greater than 100% of Swiss GDP, too big to fail by any metric. Now, when a couple of weekends back, the U.S. banking regulators tried to find someone to buy SVB, they failed. The result was potential systemic risk and emergency intervention that has, by regulators, that's risked abandonment of a lot of market discipline and market chaos. And the deposit insurance fund and eventually banks and their customers must take the hit. But when Swiss regulators tried to find a partner to buy out Credit Suisse, they succeeded. And at this point, it looks likely that the Swiss taxpayer and their DIF will be off the hook for this giant bank's failure. And the difference was contingent capital. Because when Credit Suisse got into serious trouble, their contingent capital triggered and injected $17 billion of equity into Credit Suisse. This was absolutely essential to finding a buyer for Credit Suisse, since, as you know, Credit Suisse was bought for about $3 billion, but only after the $17 billion of capital injection by their contingent capital instruments. So the Swiss contingent capital succeeded at its two design objectives. First, to prevent contagion, and secondly, to keep the Swiss taxpayer off the hook for the failure of a truly giant bank. Now, if Silicon Valley Bank had been forced to carry an appropriate amount of contingent capital, then capital would have been automatically injected sometime probably Friday at the latest. And it was very likely that a buyer could have been found over the weekend as well. And we would not be having this hearing today. In fact, it's possible that they would not have gotten in trouble in the first place, since Silicon Valley Bank would have had to answer not only to the regulators, but to the bond markets for their risky practices. When they went through their gigantic growth spurt, they would have had to issue a lot of contingent capital instruments. And I'm pretty confident that one of the wizards in the bond market would have said, this is interesting. This bank is, has very flighty deposits and essentially no risk management in place. Maybe we should charge a pretty big risk premium, and the markets might have detected that. So my question is this, Vice Chair Barr, as part of your holistic review of bank capital requirements, will you commit to finally seriously considering contingent capital requirements in the capital stacks of large banks?
Thank you very much for your question, and I very much appreciated our conversations over the years on this very question of contingent capital instruments. Both the FDIC and we have issued an advance notice of proposed rulemaking of a different type of contingent instrument, a gone concern capital instrument that would be required for large banks. But I think it does make sense to consider alternative options, and I'd be happy to continue the conversations with you about that.
Okay, and I would specifically appreciate it if your analysis included a counterfactual analysis of how much better off we would have been if regulators had listened to Congress and included contingent capital requirements into the capital stacks of these banks. Because I think there's a lot to be learned from just the counterfactual analysis. I'd like to just close out by finishing up a little bit with questions about the non-responsiveness of SVB management to the early warnings they got. Is there leverage that we can provide you? An obvious one is to say all of these matters requiring immediate attention and so on are private. And what, for example, if they had to become public after 60 days if they were not resolved? Would that have lit a fire under the chair of the management? Are there other things? For example, you could say any management that had an ongoing a pending MR, matters requiring immediate attention, we'd simply put all the bonuses in escrow. That would almost certainly get their attention. So if you could include these sort of ideas, I'd appreciate it.
If you'd submit for the record, Mr. Grunberg, Mr. Barr. Now recognize Mr. Emmer of Minnesota for 5 minutes.
Thank you, Chairman McHenry. Thanks for holding this important hearing today. The collapse of 3 regional banks over the course of 2 weeks is directly related to failed Democrat policies. Record inflation as a result of reckless government spending led to historic interest rates that banks were not ready to manage. It appears financial regulators were not appropriately communicating financial risks of the high-rate economy with banks in their supervisory capacity, and this administration's political attack, quite frankly, from the highest levels of our government on the digital asset industry, which, by the way, had nothing to do with causing the runs, sparked fear, leading to bank runs at Silvergate, Silicon Valley Bank, and apparently Signature, bringing these core issues plaguing our economy and the broader banking sector to the surface. Let's not be fooled. Providing financial services to legal businesses in the U.S. should not be risky. But this past month has proven that the mismanagement of our monetary policy has apparently made it risky to put dollars in a bank. Mr. Grunberg, will the FDIC sell off Signature's deposits from digital asset businesses? Yes or no?
We're returning those deposits to the depositors, Congressman.
So, okay. Does the FDIC plan to sell the intellectual property for Signet?
I believe that's already been sold out of the Bridge Institution, Congressman.
All right, we would like to see that information. Will you commit that a bank that buys Signet will be able to use it to facilitate 24/7 access to the banking system for digital asset companies?
I'm happy to look into that. I don't know who the buyer was, but be glad to look into it and follow up with you in regard.
You're not going to block the buyer from doing 24/7 banking for digital asset companies, is that correct?
If that's the nature of the acquisition, yes.
And will you commit that a bank that buys Signet, or the bank that did, will be able to onboard new digital asset customers?
Again, I'd like to look into the transaction, but I'd be glad to follow up with you in regard to it.
When the FDIC sold off Silicon Valley Bank's deposits to First Citizens, did that include deposits from any digital asset firms or VCs in the digital asset space?
I believe all of the deposits from the failed Silicon Valley Bank were transferred to First Citizens.
Including the digital.
All of them, yes.
Were all of SVB's deposits from digital asset businesses, again, transferred to Citizens? That's what you're saying?
My understanding, First Citizens assumed all the deposits of the failed.
Has the FDIC ever communicated implicitly or explicitly, sir, to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients?
No.
Thank you. The FDIC estimates that resolving Signature Bank is going to lead to a $2.5 billion loss to the Deposit Insurance Fund, and resolving Silicon Valley will lead to a $20 billion loss to the Deposit Insurance Fund. When the FDIC sold Signature, it had the effect of closing Signet, which is an innovative payment system that facilitated 24/7 access to banking services. Frankly, a private sector innovation that apparently will be rivaled by FedNow. Signet is intellectual property that has significant value, so I do want to see that sale. Chairman Grunberg, when managing the resolution of any failed bank, the FDIC is statutorily required to do so using the least costly resolution option, thereby minimizing losses to the Deposit Insurance Fund, which is replenished by the banks through fees that are indirectly passed on to everyday Americans with bank accounts. I'm concerned that the FDIC has deviated from its statutory requirement to minimize costs here, and has opted to pursue a lazy and destructive regulatory campaign to in fact oust digital asset opportunities from the United States. No bank is designed to survive manufactured bank runs. And in analyzing what caused this fiasco in the first place, many signs point right back to you and the FDIC, this administration, and certain reckless Democrat senators. I want to thank you again for coming today, and I appreciate a response to my March 15th letter, because to me it's still clear that we have a lot of questions that need answers. And with that, Mr. Chair, I yield back.
Gentleman yields back. The ranking member of the National Security Subcommittee, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Chair. Mr. Grunberg, we know that both SVB and Signature had very high proportions of uninsured deposits, somewhere between 90 and 95%. Can you share with us or explain to us what the typical ratio is for your average bank and how this factor played into the bank run that we witnessed on March 9th?
Thank you, Congresswoman. It's an important question. I think fair to say these two institutions were outliers in terms of their exceptional concentration of uninsured deposits, both around 90%. In the regional bank space, between 100 and 500 or 600 billion, I think it's generally in the 40% category. So these two institutions were outliers, and it was a significant part of the liquidity risk on their balance sheets.
And would you say that this high proportion of uninsured deposits left the bank more susceptible to this run?
Yes, it was, I think.
Let me also have a follow-up question to you. We've heard many ideas proposed about modifying the $250,000. And we know in, I think it was 2008 with the Emergency Economic Stabilization Act, we went from 100,000 to 250,000. So, for example, what about temporarily insuring all deposits, increasing a limit to 500,000 or $1 million, insuring all deposits for small and mid-sized firms, or limiting it for the largest financial institutions? What are your thoughts on some of these proposals?
Well, as you understand, Congresswoman, the coverage for deposit insurance is statutorily set at $250,000 per account. So to adjust it would require legislative change. And as I indicated earlier, the FDIC is undertaking a comprehensive review of our deposit insurance system, and we'll come back with a report that we'll release publicly outlining policy considerations for...
So is this one of them? And you can weigh in also, Mr. Barr or Ms. Lang, on, I mean, you're experts, you're testifying here on your opinion. I understand that it's statutory. and requires it to come back here. And certainly, as you know, we've changed many things over the years in rooms like this. So to the public, I don't want you to think that this may be as far-fetched. We had large banks when we had too big to fail, and we're certainly more than $50 billion now as we had legislative ways to change it. So what are your thoughts on increasing? That's one of the number one things I'm getting from constituents. You know, it was just in 2008, it was 100,000. We made the change then through an emergency act. What now?
Congresswoman, I look forward, the FDIC, as Chairman Gruenberg mentioned, is doing a review of the deposit.
Would you support an increase?
I would support a study and proposals for reform if needed. The rise in uninsured deposits, it has been increasing over the years.
Okay, only because my time is running out. Mr. Barr, and the next question is going to be for you, so.
We'd be happy to work with you on thinking through that. I think taking a step back, the important thing is that our banking system is sound and resilient. The actions the regulators took demonstrate that deposits are safe, and we'd love to continue the conversation.
Okay, I'm glad you said sound and resilient. In your opening testimony, you said the same thing, that you thought banking was sound. You also used words like strengthening the public confidence. Or paraphrasing it. I'm from Ohio, and the Public Pension Fund nationwide, as you know, lost millions of dollars that were invested in SVB and Signature. In my home state of Ohio, the state teachers' retirement system took the biggest hit, with some $27 million that was invested in SVB. Representing, I know, maybe only 3 or 4% of the fund's total portfolio, but I'm concerned about reports that the CEO of SVB unloaded millions of stock in the days and weeks leading to the collapse. I know that we're expecting a report on the Fed's investigation of SVB in May, but is there anything you can share today regarding the bank's executive management? And okay, thank you, Mr. Chair.
If the panel would respond in writing to Mrs. Bailey. We'll now recognize the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman, for holding this important hearing. And Chairman Gruenberg, I'd like to discuss, and I know my colleague, Congressman Williams, Chairman of the Small Business Committee, has focused on this before, but I'd like to discuss the special assessment fee that will be used to cover the losses from the uninsured deposits. You've explained that the proposed rulemaking for the special assessment will occur in May of this year. And while you're thinking about that, be thinking about a discussion of the flexibility that FDIC has during the rulemaking to ensure that our small community banks don't disproportionately carry the burden. Being one of the older members of this committee, I've been around long enough to have observed firsthand several banking crises. 1982, I was getting ready for my final semester at Oklahoma State when a little institution in Oklahoma City called Penn Square went down and took First Continental Illinois of Chicago down with it, a bank from the 1840s or 50s. Took First Seattle down with them too. Now, FDIC and the regulators responded in the appropriate fashion and addressed that. But it was a combination of collapse in the oil and gas industry and in production agriculture. And the chain reaction in my great state was the slaughter of community banks. The slaughter. There was no quarter given to those folks. They were locked up, chopped up, sold out. The legislature met in the middle of the night to authorize not just one town, one physical location, one charter banking, but we went to branch banking because it was all falling down on us. The people who I represent were brand new, young banking men and women 40 years ago when they saw how community banks were handled in my state. They weren't Penn Square, they weren't First Continental, they weren't Seafirst. They're now my most senior bankers 40 years later. And they're looking at this situation and they're saying to me, we've been the least problematic of any sector in the financial services industry for decades to the regulators and the FDIC. But yet, in every crisis since then, we've been kind of the orphans. And this time they're saying, we were wiped out as an industry 40 years ago, but now we're going to get a special assessment to pay to fund for the mistakes of the most sophisticated institutions, the biggest institutions. Can you tell me how it's possible when this special assessment fee process is completed that my community bankers aren't going to wind up disproportionately paying for the mistakes and the folderol of the biggest institutions in the country? Or are they just be prepared to be the goat one more time?
Critically important question, Congressman, keenly sensitive to it. We have discretion under the law. We have to act pursuant to a notice and comment rulemaking. Anything we put out will be subject to public comment, but we have discretion, as I indicated earlier, and will repeat, we'll be keenly sensitive to the impact on community. I don't want to front run my board. We're going to have to do a notice and comment rulemaking, but I hear you and keenly sensitive to the point you raised.
I would just offer once again the observation. The perspective of my community bankers is, if you're big enough, we've now given you an emphatic protection. It appears with what we've done in the last few months, if you're in that intermediate range, we're going to protect you. But if you're the little bankers, the little guys and ladies out there meeting the day-to-day capital needs, you're going to be the one to pick up the bill. And I kind of appreciate their point, having lived through 40 years of these experiences in my great state. Shifting to another question. As has been discussed today, Treasury approved the systematic risk designation on March 12th, upon the recommendation of the Federal Reserve and FDIC. I want to discuss for a little bit the process leading up to this. I think it's important that we have a clear picture of how the regulators made this designation, and not just in theory, but in practice. So, Vice Chair Barr, could you provide insight into which regulator acted first in proposing that uninsured deposits be protected? These are the kind of questions I'm getting back home. And while you're thinking about that, were there discussions between the FDIC and Fed prior to the respective board meetings?
I see my time has expired, but I'm happy to follow up with you.
You can go ahead and answer it.
I bet somebody will
really
take
heightened
time
right now and interested. Plus, we're close to getting a little break here, so.
I'm happy to. So
please, thank you.
We were in conversations, all three agencies, over the course of that weekend, trying to think through what the potential ramifications might be in the financial system. It was a very difficult judgment to make. It involves, of course, information we're getting from around the system, from hearing from community bankers.
If the gentleman will give a timeline of those conversations between the two agencies and the two principals of the FDIC and the Fed for a written statement. Gentleman's time's expired. We'll now go to Mr. Vargas of California.
Mr. Chairman.
For 5 minutes.
Thank you very much, Mr. Chairman, the ranking member. I guess I'm looking at this a little bit differently. And that is, we could have been here today looking at the collapse of hundreds of banks. We could have been here today trying to figure out how to stop the contagion. But instead, we're here looking at significant banks with significant problems. I think that that's important. But I think what's more important is that everyone worked together. We certainly have our ideological differences, and they're significant. I mean, I heard right away it was Biden's fault, from some members, and I could easily say it was, hell no, it was Trump's fault. But the truth of the matter is that, we're out of our ideological silos and trying to figure out practical solutions. I want to thank the chair. I think the chair worked very, very hard on this, and I think that he probably was a little uncomfortable with his ideologues on his side, maybe, but I think he did a fabulous job, and I want to thank him publicly. I think the ranking member did the same. I think they worked very, very closely together to try to figure out, what can we do as a legislature to make sure that there's not contagion. I want to thank all of you. I think all of you acted very honorably, nobly as you should have, to try to figure out what's the solution here. And again, I appreciate that deeply. Again, we could be here talking about a disaster, an unmitigated disaster. I was worried about that. I mean, I worry about these things, and we're not. Instead, we're looking at these important issues. So now that we are, I got that off my chest, I do want to ask you, Mr. Barr, you were quoted quite extensively for saying, let me get it correctly here, I don't want to put words in your mouth. To begin, SVB's failure is a textbook case of mismanagement. Was that a correct quote?
Yes.
Well, then why, the natural question is, to begin, why wasn't there a textbook case of enforcement?
I think that's a good question, one we're exploring very much. The supervisors looking at the bank identified the problems with the bank. And the question is, did they identify them with enough level of urgency? Did they escalate appropriately? And I think that's what is an incredibly fair question we're looking at carefully. I expect that we're going to find that we need to have more of an emphasis on supervisors using the tools they have more promptly and putting in mitigants in place more promptly when they see problems at banks that they're supervising.
Yeah, in fact, they had a number of MRAs, MRIAs, I guess, and it didn't seem like you did anything other than write a letter. I mean, it didn't seem like there was any enforcement. I mean, where was the stick?
Yes, I think that's exactly the right question. Normally, in the supervisory process, when a supervisor issues an MRA or an MRIA, the bank promptly takes care of those matters. In this case, obviously, it didn't take care of them in such a way that it prevented its
It seems like they blew you off. I mean, it seems like they blew you guys off and you didn't do anything. I mean, that's what it seems like for reading all this information. I can tell you, maybe I'm wrong, but that's what it sounds like.
Yeah, I think that, again, we're looking at the whole supervisory record. I share your concern very much. I think it's something we're going to have to explore both in terms of the way the bank responded and the bank's responsibility for its failure, but also should regulators have used tools to escalate more promptly and quickly? I think that's a completely fair question.
Okay. Chairman Brunberg, in your hearing before the Senate Banking Committee, you testified that the collapse of SVB and Signature Bank demonstrate the implications that banks with assets over $100 billion can have financial stability issues. I think that's what you were quoted. Additionally, you stated that the prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rates hike. Can you please elaborate more about what prudential regulations need to be reviewed? What steps can we take to mitigate the potential for similar bank failure?
Thank you, Congressman. Look, I think we should start with supervision and how we supervise liquidity risk. And two big things in this episode was liquidity risk from concentration of uninsured deposits and the accumulation of unrealized losses on the balance sheets of our institutions, both of which go to fundamental management of interest rate risk, which is...
Right, but the size, I'm talking about the size of the bank. I think that's significant.
And I think it applies to all institutions. I think in the past, we've looked at these regional banks and smaller regional banks, and in terms of their prudential regulation, have treated them somewhat more lightly than the larger institutions.
My time is
in light of this episode, we need to take a close look at that.
Thank you.
That was the point I was trying to make.
Well, with the wind up that Mr. Vargas gave, I just want to give him like 10 more minutes, so thank you. With that, we'll now recognize Mr. Loudermilk of Georgia for 5 minutes.
Well, thank you, Mr. Chairman. Thank you all for being here. I know you've been spending a good bit of time on Capitol Hill, but we appreciate you being here. One of the concerns that I've received from a lot of my smaller institutions, smaller banks, is with the extension of insuring deposits across the board, they felt vulnerable in that larger institutions may decide to pull deposits that they have in the smaller institutions because then they would be covered. Under Secretary Lang, I wanted to get a little clarity on what seems like is conflicting accounts from Secretary Yellen regarding deposit insurance. Now, on Tuesday, March 21st, the Secretary suggested deposits would be insured. She said, quote, if smaller institutions suffer deposit runs that pose the risk of contagion, then that was the end quote. Then during her testimony to the Senate Finance Committee the very next day, the Secretary said she was not considering, quote, blanket insurance or guarantees of deposits. But then a day later, she said that Treasury, quote, would be prepared to take additional actions to protect depositors if warranted. Could you clarify the Department of Treasury's position regarding deposit insurance?
Yes, thank you, Congressman. As Secretary Yellen has said, we have used tools to prevent contagion in the banking system and have reflected a commitment to ensure that all deposits are safe. And that means we would use the tools again, if needed, to ensure that Americans' deposits are safe.
So your answer is yes, you would include smaller institutions, smaller banks, community banks, or, I mean, I'm a little confused.
If conditions warranted that deposits that smaller institutions could pose a risk of contagion to the broader system, we would absolutely use the tools.
So I guess the question would be then, what is that condition? If it starts with one community bank, then that would be a trigger, or do you have more definition of what would be the condition?
I think it's very difficult to just make decisions on the hypothetical, but in this environment that we made the systemic risk determinations based on unanimous approvals from the FDIC and the Fed, we determined that the risk of contagion in the banking system was very high.
So with that and the action of extending it to larger institutions, regional banks, and then smaller institutions, do you have concerns that regulators may be creating moral hazard across the entire banking system?
I think we are concerned with addressing the current situation that we are facing. We think the system has stabilized. We have information and evidence that deposits have stabilized. We will need to address reforms going forward to address concerns about moral hazard.
Okay, and I agree with you. I think that we're stable at this point, but as we've seen already, things can turn around in a 24-hour period, right? And I am one of those that, from raising 3 young children and now with 5 grandchildren, consequences matter in future behavior, and we can't ignore that going forward. Last question. Why did the Secretary's position appear to change regarding the extending insurance to to smaller institutions? Why did she change her position between the 21st and 23rd? Were there internal discussions going on between the Secretary and the President or other prudential regulators that caused the shift?
I'm not aware of any conversations.
Okay. Well, I appreciate that, Mr. Chair. No further questions at this time, and I yield back.
Mr. Casson of Illinois is recognized for 5 minutes, and after this end of the series, let me restate this. After these 5 minutes, we'll give the panel a little 5-minute break, stretch your legs, then we'll come back in and we'll finish with questioning. My expectation is that then we'll be able to get through this final segment, but I do think it's humane to actually give a panel this bit of break, and frankly, I need one as well. So, Mr. Caston, 5 minutes.
I'd like to thank the chairman for putting me on the inhumane end of that transaction. Vice Chair Barr, I'm trying to understand the calendar, and I've got just 4 or 5 questions for you, and I want to walk through the calendar as I understand it. If you disagree with anything I've got in the calendar, let me know. But otherwise, I'll just try to run through quickly to get to the questions. January 2019, SVB is notified by the Fed of deficient risk management. A year later, they're notified that their risk management is not up to large bank standards. About 2 years after that, April 22 to 23, SVB no longer has a risk officer, but in their 2023 proxy statements, they say that they've doubled the number of risk meetings from 9 to 18. Given the prior concerns from the Fed, did the Fed participate in or otherwise have visibility into any of those risk meetings at SVB in that window?
The calendar you described, the dates didn't, they are some of them in the future. I think that we might need to look at the calendar reconciliation together, or maybe I misheard.
No, I'm just going up to January of this year was the last date. From April of 22 to January of 23, there was no risk officer, but a doubled frequency. Did the Fed participate in any of those risk meetings within SVB during that 9-month period?
I don't have yet the full supervisory record, so I'm not able to answer the question, but we will have that information in the May 1st.
Okay. Do you know if they were at any time cited for violating Section 165 of Dodd-Frank that requires banks over $50 billion to have a risk officer for the 9-month period when they did not?
The deficiency downgrade that occurred in the summer of 2022 focused on a wide range of risk management practices at the firm and found them to be deficient.
Okay. Moving back to the calendar, Q3 of 2022, their 10Q showed that their held-to-security bonds were $15.9 billion undervalued relative to mark-to-market, and they had $15.8 billion in equity at the time. 3 months later, their 10K for the year showed a slight improvement. They only had a $15.1 billion overvaluation of their bonds and $16.3 billion in equity. Was it perceived by the Fed or by management that they were in an improved risk situation at the end of 2023 than they were 3 months earlier?
I don't know the answer to the question with respect to how the management of the firm were viewing the situation. The supervisors were telling the firm at that time that basically their risk models were divorced from reality, that the models suggested they'd earn more money when they were losing more money.
Okay, I'm glad to hear that, because now I want to move to 2023 and sort of what happened up to March 8th. January 26, 2023, about 3 weeks after they finally got a risk officer back, CEO Becker announced that he was going to execute $3.6 million in stock sales. February 22nd, he executed those sales. March 8th of 2023, he announced a sale of all of their available to sell equity portfolio to Goldman. The same day was disclosed the $1.8 billion loss of a security sale, apparently also to Goldman. Heads Goldman wins, tails Goldman wins. And of course, the next day, a $42 billion withdrawal. Do you have any visibility? When was the security sale and or the equity sale to Goldman process initiated? In other words, when was it announced? When internally was the company initiating the process to secure additional cash from those two Goldman processes?
I do not know the answer to that question.
I'd imagine you probably also don't know whether the January 26th sale was cleared with their risk officer, who had been on board for 3 weeks when the January 26th announcement was.
I don't yet have full visibility into that transaction. I hope that we'll be able to get as much detail as we can as part of our review.
Okay. Do you know, if I'm Becker, I'm obviously in a lot of trouble. You've got a deposit base that is extremely well-heeled and very sophisticated. Was there any outreach to the depositors during this period to ask them either to provide equity infusions to the bank or other forms of capital prior to the run of the bank?
I do not know.
Last question.
All right. Well, there's a couple things that it seems like these people do not know or they do not want to answer. What's going on, guys? It's Ricky here with TechBud Solutions. Hope that you guys enjoyed that little circus. I mean, this little speech from the Fed and Congress. As you guys can tell, it's just a continuous back and forth. I feel like it's a lot of beating around the bush. I'm just tired of it. It doesn't seem like the market is doing anything too significant. If you look at the overall NASDAQ, we're going right back to where we were during that pre-market session. And that's right around, I'm sorry, not pre-market, right at market open or highs for the day. If you tuned on into our live trading session today, we hit highs of 312, nearly 312, which is a previous resistance range. If you take a step back and look at NASDAQ, we are approaching that like 312, 313 resistance range for QQQ. We have not broken above this resistance range in the past 4 to 5 days. Just because we haven't broken above it before does not mean that we can't break above it. I'm just making you aware of overbought and oversold levels. Now that we're returning back to where we are at, 312, we are considered to be more on the overbought side. So one of the things that we talked about within our live session is understanding that if there's no continuous signs of progress or momentum in the long side, then why do you still have an open position, right? Any open position is a position that's open to risk. I'm sure you guys are aware of that. I just want to remind you that there is no such thing as a perfect trader or a perfect investor. If you see that we are overbought, if you see that it's struggling to make new highs, you have to ask yourself, how much more money could I potentially make if I keep this position open? But also, if I keep this position open, how much more money can I potentially give back, right? This is where the idea of either reducing your position size at overbought levels begins to make sense. And again, I break this down in a little bit more detail in our LPP lesson library. But I'm going to leave it at that. Again, it looks like we are all done with this Committee on Financial Services. So it seems like they're in recess right now. So I really do appreciate you guys tuning on in. I hope that you guys enjoyed it. Friendly reminder, we are running our biggest sell. If you want the ability to watch me trade live, you don't have to, right? You don't have to join this. But if you're tired of trying to figure this out on your own and you think that it would be of value for you to watch me trade live every morning, I work with one team and one team only, and I do trade live with them every single morning. So it's not just, hey, I post my profits or my losses. It's not that. You get to see my entries. You get to see my exits if I take trades, right? But most importantly, you get to hear my thought process behind every trade. Right now, we're running our biggest sell. Again, it's a one-time payment, lifetime access. You guys know the deal. You don't have to sign up. I'm making this very clear. You do not have to sign up if you do not feel like you are ready. But if you want to condense the time that it will take for you to figure this out, that is the whole point of LPP. It's not going to be you sign up and then you automatically are going to know what to do, right? It's still going to be problem solving. The stock market is still very challenging, but the idea is to be a part of a team where if you ever have questions, I can answer your question in real time. That is where the value is. If you have a question during my live, you ask me during the live, and I answer it for you to the best of my ability. That's a question to ask yourself. Is that something that you would value? If not, I respect that, and I wish you nothing but the best with your journey learning how to trade. But I do want to remind you that we are running our biggest sale, and for all new members, you get entered 5,000 times for the GTR giveaway or $50,000 cash. And again, that's that second link down below if you want to learn more about that. Also, do not forget to select your favorite items at shoptechbuds.com. And that's for every $1 you spend, it equals 5 automatic entries. And that is for the GTR giveaway. And that is this fourth link in the description down below. So as you can tell, there's 2 ways to enter the giveaway. You can pick up items on Shop Tech Buds, or you can sign up for LPP 2.0. So appreciate your time. Hope that we're in your thumbs up. Please be very careful and cautious with your position. There is no break-if pattern. I'm not here to make things more complicated than what they are, right? Market is still bullish as of now, right? We're still above the moving average. We're still above the EMA. It doesn't make sense to have an open short position right now, but we are overbought enough where considering a short position, if we break below the moving average once again on the way down, can be something to entertain, right? We're overbought based off previous patterns that last time we sold off. And again, we make money as we sell off if we short, but our job is to wait for confirmation. So this is why we just either stay cash or wait for that proper confirmation to open that short position once we get confirmation of that overall sell-off. So I really do appreciate your guys' time. Let's see. No one asked the $1 trillion question. Why are they entitled to a bailout? Who is paying for it and why? So Robert Watson, that's a great question. So supposedly, and again, this is just because I've read a couple articles on this. So Robert Watson is asking why are they entitled, as in banks, entitled to these payouts? Who is paying for it and why? There's actually this bailout fund that banks pay into. And supposedly all of the money that has been used for these bailouts has only been sourced through this bailout fund from the banks. So supposedly no taxpayer money from people like you and I have paid for these bailouts. Do I believe that 100%? Nah, not necessarily. I don't know how to make it seem like I would completely agree with that. No, not really. But according to the Federal Reserve, that is what is being done, right? There's only a specific amount of capital that has been that is within that fund, and that is being utilized. So obviously, if things get worse before they get better, then yeah, they probably will tap into our reserves of what we pay into, and that's going to be the unfortunate part, where we have to pay for their inability to manage risk, right? But trust me, I mean, it's always people like you and I, right? We don't run these huge banking institutions. It's not people like you and I that benefit from it. So what we can do is just better prepare, right? You can complain, you can put, your finger to the sky. It doesn't matter. Like, how mad you get. Being mad doesn't do anything. It's how you can be proactive about this. It's taking time to understand this scenario and try to the best of your ability to prepare to be able to make money, to capitalize on it, right? I'm a capitalist, and that's what I like to do. I don't care if the market's bullish or bearish. I will short the market when it sells off. That upsets some people. I will go long and buy the dip if direction is in my favor and risk to reward ratios are met. That's my main focus. I focus on one thing and one thing only, and that is market direction. So I really do appreciate you guys' time. If you guys have any questions, you guys know exactly how to reach out to me. I want to answer any questions you guys have. Just shoot me a direct message via Discord, and that's that first link in the description down below. And for those that are asking, this is the Webull trading application. It's free for everyone in the US, and that's that fifth link in the description down below. If you want to take part of their 12 free share sign-up bonus, you just have to deposit $5. So what do you think about home sales? John, I'm going to be uploading a video in just a couple of minutes that talks about the pending home sales report that was just released. We talked about it a little bit during our live session with LPP, but I'll make a video and I'll post it on YouTube. So appreciate your time. Make sure you guys subscribe, drop a thumbs up. Like always, let's make sure that we end the year on a green note. Take it easy, team.